Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 126th VideoCast, 116th podcast for the week ending March 17th, 2022. What an exciting week. We've got a lot of great stuff to cover, but first and foremost, we'll quickly go through the media. Want to thank Liz Clayman and Ellie Terrett for having me on Fox Business yesterday. We'll go through some new picks from that segment. And that's Liz Clayman with her 2 thumbs up. Always love to see. It's like the comedians that used to go on Johnny Carson, and they knew they crushed it when Johnny Carson would invite them over to the couch for interviews. So the 2 thumbs up, I'll take it. Next, we were on with Rochelle Akufo on Yahoo Finance. Want to thank Rochelle and Taylor Clothier for having me on. That was all about China and Alibaba. They called me in the morning. I said, sure, I'd come on at 4:20, and that was a great segment. Then I had a 20-minute podcast on Harvest, which is kind of at hvst.com. It's like an institutional platform for a bunch of institutional research. So I got a chance to go on with Justin Jarman and Samantha Butensky. I want to thank both of them for having me on. I've gotten a lot of positive feedback on that, so if you have time, you can go to the website and listen there. And to find any of these, by the way, you just scroll down on the website right here, under categories, click on Featured On, and they all come up. And then moving right along, this one was really interesting. I did a podcast with the Pitch Board, and want to thank Andrew Hepburn as the interviewer and Jennifer Merchant for having me on. This was a 45-minute interview, and Andrew really did an amazing job drilling down, getting under the surface, uncovering, how we think about investments, how we adjust as the data change, how we change our minds, and we went through some case studies, and I think people are going to find that extremely exciting. I've already received a few emails on that. People were blown away. So that was the longest interview I've ever done, and it was really great. So kudos to Andrew Hepburn on that one. And then want to thank Chibuke Ogu for including me in his article on Reuters today. And this was about the Fed. I said the big surprise yesterday was the dot plot. Referring to the Fed's interest rate projections. It was a dovish hike, but a hawkish rhetoric and outlook. We believe that if they go anywhere near their projections, they'd invert the yield curve and cause a guaranteed recession. And we had a relief rally yesterday, and the market is digesting that today, consolidating a little bit and trying to get comfort with the reality versus expectations in terms of what the Fed is projecting. We'll talk about that a little bit more. They're not going to be able to raise anywhere near what they're projecting, but that's a smart jawboning tactic until they start to roll off the balance sheet. Okay, this was last week, a couple things. Also, Chibuke Ogu, thank you. And I said everything seems to be headed towards an acute point where we should have some headway. The fact is neither side has a complete advantage, and as a result, talks are the most sensible outcome with some type of resolution. And the point I was making to Chibuke is, look, if Russia had an edge, I mean, certainly they have the nuke, so they're always going to have some edge. But if they felt like they were making headway, they wouldn't be talking, they'd just be taking. And that's not been the case, which is a good thing. And hopefully we'll get some negotiated settlement. And then it was another quote, the Fed is expected to raise 25 basis points, which is what happened. So also that day, want to thank Devik Jain and Sabatajan Contractor for including me. And I said what we should be focused on is that the talks are going to continue between Russia and Ukraine. That's a positive, said Tom Hayes. So thanks to those guys. Now, a few quotes to just set up context for today's podcast videocast. Seth Klarman, the single greatest edge an investor can have is a long-term orientation. And I couldn't agree more. People sometimes say, well, what's your hedge? My hedge is time. When I understand what's going on in an underlying business and I can buy it with a large enough margin of safety, hopefully with some imminent catalysts, but even so, my hedge is staying power. I never over leverage where any one position can take me out on a stretcher. And I know that long-term businesses, high-quality businesses, they trade in ranges. They shoot they overshoot on the upside in terms of multiple expansion. They overshoot on the downside in terms of despondency and euphoria. And, I buy somewhere near despondency and complete depression, and I sell somewhere near euphoria and panic buying. And I rinse and repeat. And we're going to go through some good questions on that today. I liked Ray Dalio's quote, "In order to be successful, you're betting against the consensus and you have to be right." And I think that ties in very well with what Seth Klarman says. Most people think right is 90 days. And, it's beautiful when a trade works out in 90 days or 6 months. But the biggest money makers take a lot longer. You've got to give them breathing room. Like I've been saying, they don't give away multi-baggers for free. You don't hook the big marlins by mistake. They're going to fight underwater until you can pull them out, and sometimes it takes a little longer than expected. But once you get them, you get to hang those suckers on the wall and look at them for the rest of your life. So, and by the way, grays. If you ever done taxidermy, what an unbelievable business. I mean, they take your few $100 deposits for fish, and then they sent me like $7,000 of bills to send all the fish up, and of course you have to do it. So if they ever want to go public, I would definitely be an investor in that business. It's a monopoly. It's they got you by the what, and they pulled that on me in Mexico, Cabo, 15 years ago, and I went for it. You just got to do it, and God bless them. Final quote from Ray Dalio: "The average man tends to buy high and sell low." I think the second part of this is the average man does not think that they tend to buy high and sell low. But if you look at the results, that's exactly what they do on average. And finally, from Ray Dalio: "To make money in the markets, you have to think independently and be humble. You always have to know that there can always be things that you don't know that you don't know. And that's why you have to assume that any position you put on could go to zero. And would you live another day? And the secret in this business is they never take you out in a stretcher. And that's how we've thought about everything. And, that right there is the key to the business. And so I want to cover a bunch of questions. We got a bunch this week, and I'm going to cover the good, the bad, and the ugly. We're not going to pull punches here. So first off, Bill C. sent last Thursday, probably while we were recording. "Hi, Tom. What do you think will happen to the U.S. Chinese companies and ADRs that are not currently dual listed in Hong Kong? I know you said you converted your BABA shares into Hong Kong shares, but it seems to me that U.S.-only China ADRs without a Hong Kong counterpart are in a tough situation now under the Holding Foreign Companies Accountable Act. Even if the company wanted the shares to share their financials with the SEC auditors, Chinese law currently prohibits. Is that correct?" They're working on this. We're going to cover that, actually. So they're working on a resolution to this. Most of the ones that don't have ADRs are working on getting Hong Kong shares, so you do have the fungibility. But if you're in Chinese stocks that don't have a Hong Kong ADR, you're probably in a very low quality company. So you have to be a little careful, but I do think this is going to get resolved even for some of these lower quality businesses. Okay, this one is beautiful. So Rich C sent me on Monday at 2 p.m. "Presume you saw that JP Morgan dropped BABA's price target to $65, below its IPO price. What an unmitigated disaster." So, I think Rich also... Okay, so this was the best Ask Me Anything question. I guess this wasn't a question. This was just a comment. I immediately took action. This was like the beautiful catalyst, because I know that when emotions get this high, people are capitulating. Nothing that happened on Monday in the markets was an unmitigated disaster. Because I think in terms of what happened to Alibaba's business on Monday. My guess is that Alibaba's sales on Monday of this week and profits were higher than they were 1 year ago on the same Monday, and 2 years ago on the same Monday, and 3 years ago on the same Monday, and 4 years ago on the same Monday. So there was nothing about Monday in my world that was unmitigated disaster. Now, scarcity mindset and looking at the stock price and worrying about emotions and getting caught up in the frenzy of it is natural when you're a newbie in the business. And so if that's the place that you were in on Monday, that's natural. It just means you're not comfortable with what you own. You haven't done enough research. And that's okay, because everyone goes through that process in the beginning. The only thing that could possibly make Monday a disaster is if you were one of the weak hands that was puking out your stock in fear while I was buying more. And what I did literally within an hour after I received this email, because it triggered something in me from a couple decades of experience that I know when there's just panic in the market. And I said, if I don't buy more here, and you all know I've got plenty of Alibaba stock, okay? There's no two ways about it. And we've brought our basis down a ton in recent months by just adding more, similar to the Range Resources story, which I go through in both of the podcasts. But I said, I can't not participate at this level of fear. When everyone's just puking like this and everyone's crying and nervous, this is the opportunity of a lifetime. So what we did, for every $10 million of accounts, we bought the December 105 calls. And the reason we bought December is because, remember, the China National Congress is in November. So in the 12 months leading up to it, on average, the MSCI China is up 31%. We bought the 105s. The stock was, 75 or 77 on Monday and Tuesday. And we paid $8.42. So for each $10 million, we bought 100 contracts, which was only $84,000, $84,200. And we control, at 100 contracts, 10,000 more shares. So for $84,000, we got another $1,050,000 worth of stock at $105 when it was in the toilet, and I was getting emails like this when it was $75 or $77. So basically, we'll have to get Rich C's mailing address, because each one of my clients that has $10 million 12 months from now is going to make an extra $1 million that they wouldn't have made because of Rich's email. So we'll be sure to send the golden pears, as they do, whatever they send on Christmas and the holidays. But and I'm not picking on Rich C, because it's natural to be scared when you don't do the work, and when you're new in the business and you think and you trade on price. You know the price of everything and the value of nothing. What we're trying to help people understand with this podcast, VideoCast, is how to understand the value of something, so you're not shaken out when you're in one of the highest quality businesses in the world that's trading at one of the lowest multiples because of exogenous events. Next, Mark Rittinger. What will it take for you to change your mind on the China tech thesis? This was, I think, the same exact day that he sent it when it was flushing out. So maybe why I took an hour is because I got two of these emails. Your BABA position must be tremendously underwater by now. Well, it's gotten a lot less because of Rich's email, and we have brought our basis down quite a bit across the board, 130s, etc. And so I answered this question last week. The only thing that would change my mind on the thesis would be accounting fraud, and I explained why I believe that was effectively, infinitesimal possibility. It's a possibility with any company in the world, but Alibaba, if that were to happen, it would close the capital markets to China forever. No one would ever put another penny there. So plus they have PwC, etc. So decent question, again, fear-based. Ben, first name only, with regards to your steamroller analogy in the podcast, as well as my angle has always been in possible shorts, not longs. That makes a lot more sense. So I appreciate that. I did cover in the podcast, though, I'm not eager to be shorting here, even though I do think the trapdoor is going to be empty, and we started to see signs of that in the past week. And I wouldn't. So what he's saying is, he wants to short XOP on an Iran deal. I wouldn't play that, because I think the secular thesis for 3 to 5 year cyclical thesis is going to be intact for energy. So on a trapdoor thing, I'd be more inclined to wait for a collapse and then load for the long term than try to pick the short. Because if you get some type of like extended circumstance in Russia, Ukraine or something, you can get your face ripped off. You could buy puts if you want, but the implied volatility is too high. So it's just not the ideal setup. It's not a good asymmetry. Rich C, again, Tom, really like your investing style. It aligns with my 36 years observing the investment management business, most of whom are followers, not you. Question. China ADRs are getting destroyed by SEC threats for delisting. In the past, you have poo-pooed this exogenous factor. Like it or not, this is real based on today's actions. No, there's nothing different about what happened in the market and what I said before. The difference is the price changed and you got scared and you let your emotions take you out, just like all the retail. Because look, there were no institutions puking stock on that basis. This was all weak hands, and all of these assets got transferred to strong hands over the past week. Institutions know that shares are fungible and they could just swap out to Hong Kong. So this was weak hands getting pushed out, and this was a sell the rumor, buy the news event. We covered it in last week's podcast, and sure enough, that's exactly what it turned out to be, and we'll talk about some reasons why. Quote unquote, it's a huge albatross around Baba's neck. I am good trading on fundamentals and technicals, but this doesn't work, and a huge regulatory overhang. So don't do it. I mean, it's a free country. You don't have to own Alibaba. There are hundreds of other stocks that are great. I was looking at 3 industrials today that, with my junior analyst. So, it's free country. At least this one is. Can you bring an attorney with creds on the program to give a reality check? Otherwise, I find these China ADRs uninvestable! Okay, well, don't invest in them. We don't need an attorney to tell you shouldn't be investing. You probably shouldn't be investing in a lot of things if you have that level of emotionality and an unwillingness to do your own work and be burdened by the facts. Now, again, this is not criticizing Rich C, otherwise I would say his whole name, which I can see in his email address. This is really valuable that he sent that, because I think there were a lot of people in that same boat that got shaken out. And you only have to have that happen to you once to never let it happen to you again. Number one, you'll never go into a position without doing your own work. And number two, once you've done your own work, you'll never let them shake you out. Because that's the way multi-baggers work. They got to take out the weak hands. They've got to punish you. They've got to white knuckle you when you're buying that last 100 contracts that's going to control 10,000 shares at $105 for your clients because you see panic is seething in the market. That's just, you got to live through it and you got to have experience. And that's why, they don't write books about the people who got blown out. They write books about people who go through these experiences, learn from them, and come back bigger, stronger, and better. And that's what I hope for all of you. Okay. Okay, Rich C again. Listen to the podcast on Alibaba share. I must admit I'm confused. You implied that in the event of delisting, the Buybacks shares would swap to the Hong Kong market. Will that happen automatically? That doesn't seem likely. Would an investor need to sell their Alibaba shares and rebuy in Hong Kong? Look, we said months ago to transfer to Hong Kong. There's no downside to doing it. It's a few $100 depending on how many shares you have. It's probably less than that in your case. And then you could always swap back after this thing's resolved. It looks like it's going to get resolved imminently now with some developments this week. But what's the downside? So I don't know why you'd wait till the end when there's zero liquidity and everyone's panicking to do the same thing. Why not just get it done? I mean, be proactive in life. But that probably answers the same question for a lot of people. Okay, Tyler Woolridge. Hi, Tom. Firstly, been listening to you for about a year now, and you're consistently great. Wow, a nice comment this week. I'm so happy. Your podcast is easy to listen to and digest, and it's turned into somewhat of an end-of-week treat and tradition for me. So thank you for sharing your wisdom and opinion, not financial advice. My question, have you heard of Alibaba? Joking. That's funny. My real question, what are your thoughts on the British clothing brand Boohoo, ticker BOO, I have an entire thesis based on DCF, European warehouse expansion, etc., for why I think it might be a good long-term buy. Okay. So I did a quick look at this for the call. It's a British company. We are starting to look at European stocks. I didn't expect that I was going to find anything here, but it's kind of interesting. They are dramatically growing revenue. The price has collapsed. The business is growing. The gross margin is staying firm. Net margin is anemic like most clothing retailers. Return on equity is strong. It's declined a little bit through COVID. But it has promise. So I think that, it's at the low end of its multiple range. I'd have to get a better understanding of the business, return on invested capital. I mean, you put a gun to my head right now, I'd buy some shares. But I've got to do more work. So what you ought to do is send over your DCF and analysis, and I'll have a junior analyst take a look, and if there's something there, we'll come back with more information next week. But I think generally your thought process is right here, and good job. Second question, a little different. I'm a research scientist, PhD, but have discovered my passion for investing. Currently studying for a financial qualification to build my knowledge CV. What's the likelihood of someone like me getting accepted to private equity, hedge fund related roles? I think they're strong. I think, if you're mid-career, you need to get the CFA if you want to do that. That will say, okay, he knows something, we can teach him, and that's that. And number two, keep a personal account going with your investments, because the name of the game is, even if you've only got $10,000 or $50,000 or whatever, if you can show over the next couple of years while you're getting your CFA that you can get reasonable returns and you're a thoughtful thinker and you learn from your mistakes, that's also going to probably be as valuable, if not more valuable, than what you pick up in the CFA and the other things that I've talked about, all the Buffett letters, Intelligent Investor, read a value line company every day, etc. Be healthy. Ben, first name. Tom, okay, this is a good question. Ben asked, Tom, if you have a minute, do the biotech earnings revisions you published today help or hurt your biotech thesis? So, Carter put up the IBB earnings revisions, and they came down. The answer is no. They don't hurt our thesis. So they came down 9.14%. For 2022, and for 2023, they came down 6.74%. And you have to expect when we started the thesis, they were down like 40 basis points. when the ETF was down like 40%. So it was like earnings are flat and the ETF is down 40%. Well, part of it was interest rate fears. Part of it was obviously people knew estimates were coming down, but the prices come down 40%. The earnings power has come down 6 to 9%. So there's still a huge upside opportunity in our view. After you collapse 40%, you got to recover 75, 80% to get back to par. So there's still huge. It doesn't affect it. If earnings have come down 40%, I might change my mind and say, oh, they're fairly valued here. Okay, let's just get out at flat. But that's not the case. And number two, the other part of the thesis is going to be M&A. That cycle is going to pick up huge very quickly. We've talked about the cash on the balance sheets. We've talked about the patent cliffs and the need for growth innovation and et cetera. So no, it doesn't. Great question and good catch. Okay, John Weller. I searched on how to chart a yield curve inverse and have not found it. Is the yield curve inversion chartable and free? And can you share more details? Love what you teach us, and many thanks to you all. John in West Michigan. So John, I think there's a free version of stock charts. By the way, just want to, before I mess this one up, this is the National Association of Active Investment Managers equity exposure. It went up to 46%, so it's still hugely underweight. They're going to have to chase up. Just wanted to give you the update because they publish on Thursday and the article publishes on Wednesday night. You can go to stockcharts.com and use their free version and just type in this ticker, $YC2YR, $YC2YR. That'll give you the 2-year yield to the 10-year yield spread, and you just want to make sure it's above 0. Okay, so it bottomed at 23 basis points before the meeting. It closed at 24 basis points today. So it's actually re-steepening after the meeting, anemically, but it's still moving in the right direction. So that's a good thing. We'll talk about that a bit more. Ben, first name only, what's the latest on the Iran deal and your latest thoughts on oil? Your Thursday morning sentiment article strongly infers that investors will likely switch from oil and commodities to technology. How soon and how massive? It not only implies that, I mean, that's been our underlying base case for the last couple of weeks. We mentioned it on the Clayman Countdown yesterday, a few tech ideas. We do think that with all the euphoria around energy, the trapdoor will open sometime in the next, you get a negotiated settlement, Russia, Ukraine, then you get the Iran deal, then you realize the rig count is going through the roof, and you're going to see the Johnny-come-latelys fall through the trapdoor very, very quickly, and that's when we'll potentially take a look at reloading, depending how severe the carnage is. So, good question on that. Oh, latest thought. So as for the oil thing, the Iran deal, here's the latest. It fell apart last week, and then today, as Ukraine war rages, diplomats near Iran nuclear agreement. So they're back on. They got to get it done. I mean, it's an election year. Inflation's high. It has nothing, very little. I mean, the Fed plays a role, but there are other impacts that they're trying to do, and they're going to get this done, and they're going to give away the kitchen sink, unfortunately and unnecessarily. But it's the wrong way to do it, but that's how they're going to do it. So it is what it is. Tyler Wooldridge, Tom. Oh, okay. That was the one about, have you heard of Alibaba? I love that one. Okay. All right. From JT Investor. Tom, your work and discipline on Baba is remarkable, especially after this week. I nearly lost faith when JP Morgan lowered its price target from $180 to $65, which was difficult to process mentally when thinking about basic enterprise value on the business, and you have called out the easiest path to mitigate the delisting risk with Hong Kong 9988. I also noticed Kevin O'Leary bought the dip and took a shot at the analyst price target change. He already had some, by the way, minor detail, but he's smart enough to average down in the hole, no question. Recognizing that Baba is only one part of KWeb, what are your thoughts to adding to an existing KWeb position at this time? Also, are you thinking of starting a position in EU equities, sans Russia, or Brazil at this time? If so, what ETFs would you recommend we check out? Have a great weekend and keep up the great work. You're going to be a legend when Baba hits $250. Okay. Well, let me keep some humility here. We're just coming out of the hole. We don't count our chickens before they hatch, but I know it. I have high level of confidence that it will revert back to its intrinsic value. It's a question of the timeline. I'd prefer sooner, and I think it might be sooner than a lot of people expect. But leaving that aside, thanks for the kind words, by the way, number one. Number two, I want to say this, and I mentioned it in the article of the week. The same analyst who will remain unnamed, he had a $321 price target on this stock in April of 2021. So after it came off the highs in February from 315 down, he said, no, this is a great business. Don't worry about the regulatory. It's going to go up. And I think it represented like a 36% appreciation at the time. You can Google it. And then January 7th, 6th or 7th, after Alibaba bounced, you remember in December, it got down to $100. It bounced up $30. Right after that $30 move, this analyst put an overweight on the stock, and then 2 months later, he's telling you he takes his price target from 180 to 65. So this guy has zero credibility, number one. Number two, it's evidence of what I say all the time, opinion follows trend. And if anything, the same thing happened with Range Resources. I remember these analysts taking the thing down. It was this one kid from Morgan Stanley, and now it's a 10. Now it's 7-bagger, 6-7-bagger, and it's going to be a 10-bagger in the next year, 2 years. So, I understand the headlines, I understand the fear, but anyone that got taken out of this stock, just think about the number one thing you want to think about when you're puking out stock is who's on the other side of your trade. It was people like me. And like Charlie Munger potentially, although he's already levered long on margin debt as of fourth quarter of last year. And by the way, his basis is probably around $165 if you account for all of his purchases, and he's going to make a fortune on this thing over time. So K-Web, yes, I would. EU, we're looking aggressively. We have some modest exposure. But yeah, based on the stuff, I mean, the Brazil ETF is EWZ. Actually, it's done quite well this year. We have some token positions in Brazil, StoneCo, etc. But we haven't leaned in yet. And part of the reason we haven't leaned in is, we have two huge contrarian bets. Now that they're starting to work with Biotech and with Baba, we'll probably start to lean into some more contrarian bets. But for now, we just wanted to make sure that we got that last piece of action this week, which we were able to, and really lucky about that. So thanks so much for the kind words, JT. Moving right along. Okay. JP Morgan's quant guru is sticking to his bullish outlook for stocks and says the economy will avoid falling into a recession. This is from my boy, Marko Kolanovic. I love this guy. And he actually shifted gears because if you remember, he'd been bullish, but he'd been saying only cyclicals. Now he says China's front-loaded stimulus, reopening, and relative insulation from the current geopolitical flashpoints mean the country should receive an overweight from investors. The MSCI China ETF is down 27% year to date. So this is nice to see. Smart guy, and we couldn't agree more. That thing that I just clicked out of that I won't be able to get back talked about record stock buybacks. I think it was about $250 billion already in the first few months of this year. 1.23 trillion authorized. People are totally underestimating the impact that this is going to have. Think about all the money that companies borrowed and built up their cash balances on the balance sheet at virtually no cost for the last 2 years since the Fed backstopped the market. That's now all going into stock buybacks on the pullback, and you're going to see that. And that's one of the reasons we've been saying for the last few weeks, the risk of this market is to the upside, not to the downside. In the interim, we got a war, and still we've held the February 24th lows. So what else do you need to talk about? Okay, tomorrow Biden and Xi are going to discuss Ukraine in a Friday call. That's a positive thing. Dialogue is always positive. It means that, Biden's going to say, look, you don't want to be sanctioned like these guys. We don't want to sanction you. We do a lot of business together, but knock it off. You need to press them. You have the only influence over them. Press them to get a negotiated settlement. They'll get something. They can go home and do their war in the Kremlin. They can go home and do their parade and pretend that they won, even though they got smoked. And Ukraine will live happily ever after. So hopefully that's positive. I think the market is also anticipating something along those lines. Now, what happened this week? Well, we had anticipated for some time that eventually they'd blink because what they were doing was not in their interest. He held out longer than I thought he would, but eventually he had to curve. He had to crater because whether you're in China or Chandigarh, India, or in the United States, a politician's number one job is to get reelected, and that's universal. And here's what we're seeing. Wall Street Journal, the rollback of Xi Jinping's economic campaign exposes cracks in his power. In addition to pressure from the West on Beijing over Xi's Russia entente, he is struggling with a severe slowdown in the economy. The new disquiet raises questions about his unassailed dominance. So he's got the transition meeting. His economy is in shambles. You saw the numbers in Q4. They jacked up the stimulus. And by the way, I want to say something about that. So they jacked up the stimulus in October and November. And I always say it takes 6 months on a lag basis to kick in. We saw some numbers this week with retail sales and industrial production in China that blew the doors off. No one was expecting that. They've got still shutdowns going on from COVID-0, and they crushed it. Now, because of the lagged effect, just like they overshot with the regulatory crackdown and they didn't realize how much of an impact that was going to have on the economy, they're going to overshoot with the stimulus. So it's not happening fast enough. And he's panicking because he started the stimulus 4 or 5 months ago and the economy hasn't turned around overnight. So now they come out this week and they say, we're going to do as much stimulus as it takes. So much so, we're going to help insurance companies directly buy stocks. We're going to help companies buy their own stocks back. We're going to be buying stocks. I mean, they're throwing the kitchen sink at this now because they realize they took it too far. And they're going to take the stimulus too far. Wait till you see inflation in China 24 months from now and after the stock market's up huge. So anyway, I just love overshoots. You know, it's just kind of, you know, everyone has their thing, but that's mine. So looking forward to it. So this is from China last night. This is the guy who runs the KWeb China Internet ETF, which to answer your question, you asked about the KWeb ETF. Yes, you could, because he's already converted like 70 or 80% to Hong Kong ADRs. So it's a way to buy a US ticker with Hong Kong exposure so you don't have to convert it yourself. It's in the, you know, they're going to trade similarly. I think Alibaba will outperform it over time, but he has all the heavyweights. It's more diversified. And yeah, I think that's a good way to think about it. And this guy is proactive in doing the switchovers. So, okay. China's government behind President Xi and Premier Li gave a speech at the State Council's Financial Stability and Development Committee, as reported by mainland media source Xinhua. Below are quotes and my interpretation. So, quote, concrete actions must be taken to bolster the economy in the first quarter, noting that monetary policy should take the initiative. They are going to increase money supply. That's good for stocks. Stimulus and supportive policies coming. Chinese and U.S. regulatory bodies have maintained good communication and made progress. The two sides are working on a concrete cooperation plan. Solving the Holding Foreign Companies Accountable Act and U.S. ADR delisting, the CSRC, China's SEC, put out a release already that they will, quote, continue to strengthen the communication with U.S. regulatory agencies and strive to reach an agreement on China-U.S. audit supervision as soon as possible. Next quote, support various enterprises to seek listings on the overseas market. That means U.S. and Hong Kong IPOs are allowed. Next, for real estate enterprises, it is necessary to timely study and suggest effective risk prevention and mitigation solutions and put forward supporting measures for the transformation to a new development approach, which means turn on the credit spigots again and do the same thing all over again, rinse, repeat. More making sure over-leveraged real estate developers don't call financial crisis by giving them more leverage is basically what they're saying. Relevant authorities actively introduce market-friendly policies and prudently introduce policies with a contractionary effect. Support, not hinder. And, quote, authorities should timely respond to issues that draw attention from the market. Don't screw it up. I agree with that. Specific to internet companies, especially the bigger companies, which are referred to as the platform economy. Quote, as for the platform economy, relevant departs should improve the established plans to govern the sector. They should steadily advance and complete their rectification work on large platform companies as soon as possible through standard, transparent, and predictable regulation. Internet regulation shouldn't be done in an ad hoc, whack-a-mole approach. It should be finished as soon as possible. Both red lights and green lights should promote the steady and healthy development of platform economy and improve its international competitiveness. Regulation should support the companies rather than hinder them. Interesting to note the inclusion of internet companies to go, quote, international, and that's very good news. And that's that. So those are some highlights. You've read a lot of this. China promises more stimulus to reverse the economic slowdown. The growth target is 5.5%. We're going to see fiscal. We're going to see monetary. We're going to see them buying their own stocks, forcing their insurance companies and banks to buy internet companies that they drove into the gutter. But by the way, who are they buying it from? They're buying it from the U.S. retail investors that threw them in the gutter. I mean, these guys, they're not idiots. They know exactly what they did. And by the way, historically, they have a tendency to make these announcements after they break all technical support. They do understand technical analysis and where stop losses are. So maybe all you wondering about stop losses and algos, maybe they're coming out of China because they just took a ton of Americans out of stock with ADRs. And I'm sure that they bought them hand over fist. Okay, China retail sales and industrial data soundly beat expectations. Retail sales grew by 6.7% year on year compared to Reuters consensus expectations of 3%. No one's expecting that in a zero COVID environment. And that's a lagged effect. We're coming on month 5 of that stimulus. I've been saying it over and over like a broken record, and now it's happening. And those of you who were with me in 2020 remember the same thing. I was a broken record, and then all of a sudden it just moves overnight. So Z spurs frantic stock buying with lifeline for China market. Gauge of China equities in Hong Kong surges the most since 2008. The Hang Seng is weighted with the big China tech names. Top officials vow to ensure stability in coordinated moves. China's shares fell to levels last seen in 2008. So you're basically buying Chinese stocks in a Great Depression level. So, if you don't like buying stocks during a Great Depression and getting rich, like everyone you read the books about, then this is not for you. But if you're interested in once in a lifetime or twice in a lifetime or, twice in a career opportunities, then this may be worth looking at. That's all I can say about that. Not investment advice. Go to hedgefundtips.com, click on terms, do your own homework, talk to your financial advisor, call in a great lawyer to, give you his opinion for $800 if you should buy the stock or not. But at the end of the day, these things don't come around that often. That's all I'm saying. China reported a drop in new coronavirus cases as authorities work to contain the outbreaks. That's positive. They had a spike up because they have no immunity, because they've been doing zero COVID, and the residual from the Olympics, etc. Xi Jinping's stock market put is alive and well. Zero Hedge goes into how anytime Liu has spoken, this economic chief has spoken about stabilizing capital markets, particularly in the crackdown of 2018. The average return has been 19% in the following six months for the CSI 300. It's probably similar to MSCI China. So, in other words, he follows through with his actions on balance. Okay, moving on. China finds a way to do zero COVID while keeping the factories open. That was really surprise and really good news. So they're keeping things humming for iPhone and Foxconn, even though they shut down for a few COVID cases. China's elevated COVID cases may not hit the economy as hard as feared. First off, the numbers came down, I think, overnight. And they're doing workarounds, and they're starting to show that obviously an openness to the Pfizer pill. They're not going to be zero COVID for a lot longer. That's my read. Once they have the pill, I think that'll be game over. China's tech surge. Regulator chimes in with market-friendly policies to cheer beleaguered stock investors. China will encourage publicly traded companies to buy back their shares and money managers to invest in their own funds. The government will continue to widen access to capital market and maintain Hong Kong's market stability through stronger cross-border collaboration, said the CSRC. So they're going to mandate Alibaba use that $7 billion of unused buyback authorization to buy back their stocks and do it before the China National Congress in November, so Xi can have an orderly transition into his lifelong post. And that's the name of the game. And what I was saying about the technical, look at this. This is the Hang Seng index value. And look, they broke the trend line. This is every time this guy speaks, it's like right after they break the trend line, take out all the foreigners, and then they just ramp the thing right back up. And that's exactly what we're having now. So God bless Rich C, and God bless these Chinese that study their technical analysis and shake everyone out and gave us one last bite at the apple this week. All right, Credit Suisse turns overweight on stocks, favors U.S. and China. Oh, wow. After BABA goes up 35 or 37% in one day, now they go overweight China. That's, by the way, it's still a great call here. So 2008, like cheap, the Golden Dragon China Index is trading at a rare discount to the S&P 500, going all the way back to what? 2008 Great Financial Crisis levels. Again, how many times in a lifetime do you get to buy at Great Depression levels? Right now. There was also a guy, I didn't save it. It was this, he showed like, there were only like 2 other times in history where a group had fallen like 80%. He was talking about the NASDAQ and he was talking about the Great Depression and like the amount of money made buying that. And yeah, so anyway, that's that. So opinion follows trend. Now people are going to be skeptical. They're all going to wait for the next leg down. That's probably never going to come, by the way. And I don't think they're going to let people in from here. And then probably around 150, analysts will start to go from downgrades to upgrades. Around 200, they'll start to go to neutral. And then back, when you get Alibaba in the mid 200s, everyone will start to go overweight. And it's just the way it happens. It's human nature. Now, this is very interesting. China plans audit concession, they're blinking, in the face of U.S. delisting threat. So they're going to basically come through and say, we'll show you our books, just keep the capital markets open, which is what I've been saying all along. If they get closed to the U.S. capital markets and the depth, and I think they figured that out in Hong Kong, there's not the liquidity, they're toast. And from a geopolitical standpoint, that would be the greatest thing they could ever do for America. But from a self-interest thing, the actions they were taking in 2021 were the dumbest things you could ever do to yourself, self-inflicted wounds, but it created the opportunity for us. So they figured out, it's okay to make a mistake. You just got to correct it. Now, by the way, one thing I wanted to say about that analyst that took the price target down to $65 in the hole. There's an old saying, Wall Street is the only place where people who pull up in Rolls Royces get advice from people who take the subway. And I think that nips it in a bud. Wealthy people who actually create something, taking seriously the ideas of some kid with a CFA 5 years out of school who thinks they know something about what's going on. And, you can actually... There are plenty of it. Look, you got Marko Kolanovic. You've got Tom Lee. You've got these guys. They've got a few gray hairs. They've been through it. They know a lot. They're worth listening to. And, Jim Paulson. You'll find a handful of people that are worth listening to that know their stuff. But some others, you could actually, don't be upset when they make these calls. Just look back at their history and say, can I use this person as a contraindicator? So when they say X, do Y and make a fortune. And there are a number of people out there on TV and otherwise that you can use as reliable contraindicators and make a tremendous amount of money. So you just have to sort through it. There was a Range Resources analyst who turned out to be a brilliant contraindicator. Unfortunately, I don't think he has a job anymore. Otherwise, I'd be using him. That would be the guy to follow if you wanted to short the XOP for Ben first name only. But I don't think he has a job anymore, unfortunately. So, okay, Biogen stock gains after sharing longer-term data for its Alzheimer's disease drug. This is a stock that's cheap as hell. It's in the gutter because they keep putting out data. The stock spikes up. Then the data's not good. Everyone says, no, it doesn't work, blah, blah, blah. All these armchair quarterbacks that have never read a biology book know that it doesn't work. But the FDA kind of approved it, and then they didn't. I think that's a good proxy for biotech, which is recovering now. Keep your eye on that one, but that was a positive development that got missed in all the noise. Boeing's, this is another one that got missed in all the noise. Jefferies analyst Sheila Kayaglu reiterated a buy rating with the $270 price target on Boeing, noting that China's first China delivery may already be in the air. Maybe we could get a breakthrough with the Xi phone call tomorrow and let them take some planes. That would be a good thing. Okay, this is what kind of initially spooked the market yesterday on the dot plot. The Fed took their GDP projections down from 4% to 2.8% this year. And by the way, that is what we expected, which is why we're saying, well, the data says cyclicals do well up to the first rate hike. Tech does better after the first rate hike. Tech also does better in a slowing growth environment. When GDP was going up from negative to +6, we were all in on cyclicals. Now that it's slightly decelerating, we are shifting gears and taking advantage of what everyone has sold off. They took their inflation expectations up. But the thing that spooked everything was the dot plot. So here you've got the majority now at 7 hikes for this year. A lot of that's priced in. I don't think they're going to get to 7 because he signaled that in May, as early as May, they could start with the balance sheet. And I think once they do the balance sheet and they come out of the market as a buyer, which ended this month, March, they're no longer going to be buying bonds. That will keep the 10-year yield somewhat elevated. It's not going to blow out like people think when the Fed exits the market. It's going to go to 350. It's not, because there's going to be massive foreign demand. There's a carry trade. You can borrow for negative rates in Japan, buy a 10-year yield above 2%, and mint money all day long. And people are going to be doing that carry trade. So the demand is still going to be huge, but it should tick up a little bit. And that will enable them. They can drain liquidity and slow growth a bit, while and then as the inflation numbers come in, go more moderately on the hikes, I think is really what's going to happen if they do it correctly. So you saw the yield curve collapse and then start to tick up. I think the market is starting to figure out, even with that 63% probability that they assigned after the announcement of 7 hikes, starting to say it's unlikely that they can get to 7. 4 or 5 is more realistic. Article of the week: Home Sweet Home stock market and sentiment results. In 1985, I was a huge Motley Crue fan. I had the posters on my wall. I think Tommy Lee is why I became a drummer in 5th grade. And Motley Crue released one of its major all-time highs, Home Sweet Home. And last night when I was thinking about the journey of Alibaba over the last few months, this song came to mind. The journey has had a few detours, to put it mildly, but now it's finally on its way back home to intrinsic value, which we view, in the high 200s, 280, 300. We haven't wavered on that because the business hasn't wavered on that. They kept their guidance. They're going to grow revenues and earnings by 30% over the next 2 years combined. As of earlier this week, you could buy it at 6 times earnings when you backed out the cash and the short-term investments, which is why we stepped in after we got those emails and we said, we got to have one more bite at this. Like, if we're not buying during acute panic, then what are we doing here? And we did. And that was that. So seeing Alibaba jump 35% in one day is evidence that the objective business/fundamental analysis was always accurate. It was simply a mercurial government leadership holding the stock back. Why do we know that? Because once they stepped back, the stock rocketed, and that's going to continue. With the government now stepping out of the way and letting business flourish once again, we expect this marvelous business to work its way back up to intrinsic value over time. We may hit a few more potholes and speed bumps, but we're on our way. So yeah, I love this song. I was invited on Yahoo Finance yesterday afternoon to discuss developments. Thanks to Rochelle Akufo and Taylor Clothier for having me on. So here's a caption they took out of the interview. Both in China and in the U.S., the number one job of a politician is to get reelected. Great Hill Capital Chairman Thomas Hayes says, adding, quote, I think you're going to see these Chinese stocks rip for the next 8 to 12 months into the China National Congress. We said that it was a sea change, and I'll go through some of the highlights, but this is well worth listening to, especially if you have an interest in Baba. It's 6 minutes, and Rochelle's great. I used to do interviews with her back on CGTN, so now she's at Yahoo Finance, and that's terrific. She does great work. And okay, so I said, the announcements overnight were a sea change. The underlying China tech business, which has been hit hardest, are still growing despite an historic regulatory crackdown that began last year. Only 2 things held them back. One was the government regulatory crackdown. 2 was the delisting risk. Both were addressed overnight by Vice Premier Liu He when he said, quote, actively introduce policies that benefit markets. He offered investors reassurance that a sweeping crackdown on the internet companies was nearing its end. China's banking regulator said after the meeting that it would support insurance companies to increase investment in the stock market. So they're going to come out of bonds, they're going to buy their stocks, and if they're buying any China, guess which are the biggest weights? Alibaba, JD, and Tencent. The Financial Stability and Development Committee meeting concluded there's a need to boost the economy urgently before November. I had editorial license on before November in the first quarter, and promised investors relief on several regulatory fronts. Monetary policy will be proactive in this quarter, and new loans will grow appropriately. Working with the SEC to resolve the Holding Foreign Company Accountable Act and continue listings on U.S. exchanges. So Alibaba, I went through the example of, it traded 6 times. It's going to grow over the next 2 years. You can buy it at backing out the cash and investments. You could buy it at a third of the S&P 500 multiple with 3 times the growth. And then I went through the Microsoft example where they grew the business for 7 years. The stock did nothing. Then they were up 1,500%. Well, Alibaba's grew the business 5 or 6 times as much as Microsoft did. The stock, you can buy it at 2014 levels. And I think it's going to be just phenomenal over the next 12 to 24 months. Okay, the story of Job we covered last week. Remember, I said this in the middle of the storm. I said it brings to mind the story of Job, who holders of Baba, whose faith was tested. During this test, Job lost his 10 children, his wealth, and his health. Through the turmoil, he kept his faith and was ultimately rewarded. The story ends with Job receiving his wealth back. Not just restored, but several-fold, as we're going to get with Baba, having another 10 children and living for another 140 years. I wish I could take that trade. We believe that patient and faithful shareholders of Baba who understand the long-term intrinsic value of the underlying business will likewise be restored and multiply their wealth several-fold in coming years. We went through the rebounds when, the Hang Seng is traded below book value. Historically, what happens in the next 1 to 2 years, rip-roaring rallies. Alibaba always does more than double the market since it's been public. Then I went on to, and China tech has been the least loved sector globally for months. That's about to change. The last shall be first. As always, opinion follows trend. No one wanted Baba at $75. Everyone will want it again at $250. Mark my words. Earlier in the afternoon, I joined Liz Clayman on Fox Business, the Clayman Countdown. Again, thanks to Liz and Ellie Terrett for having me on. And I put my show notes in here, but it kind of went impromptu, and we wound up giving a couple ideas. What we pointed to was, there's a common view we're moving in a rising rate environment by cyclicals, but the market's already priced in 6 or 7 hikes. So the cyclical trade is largely in the rearview mirror. I think banks could rebound here a little bit, but you've taken the middle out of it. Let's look at where there's huge opportunity. And if you look at the 6 months after the first hike, tech and REITs are the top 2 performers for the last 4 rate hike cycles. I talked about the Fed being data dependent, less rates than expected, using the balance sheet versus hikes. I talked a little bit about inflation. We've covered that. I talked about the sentiment washout, how I've been saying the risk in the market was to the upside, not the downside since I was last on. We held the February 24th lows. Now we're starting to move higher. We talked about revenge travel, and the 3 ideas we went into was Disney. You can buy it at 32% off its 52-week highs. It's going to grow earnings 29% next year. You're going to have the revenge travel. We heard from Target in their earnings call. Top sellers were suitcases and bathing suits. People are going to be traveling like crazy this summer. Their top destinations after 2 years of no travel for many people will be Disney with the kids who've been watching Disney for 2 years all day long. Disney Plus added almost 12 million subscribers last quarter, 130 million. You add Hulu and ESPN, they got 200 million streaming subscribers on top of basically a monopolistic parks business, which is, the best in the world for everyone. And you've got a great business. Oh, and by the way, they're going to double those earnings over the next 4 to 5 years. So we like that. And that we were kind of building on what Liz had said on her show Friday, which we watch every day, which she said, stay positive on good U.S. businesses, even if they're going through bad times. And what could be more American than Disney? Then she asked me, well, where else do you see? I said, well, where else I see is some of these beaten down value tech, with Facebook has been crushed. You're trading at 15 times forward. We think that's an opportunity. Intel is value tech. We think that's been crushed. That's a huge opportunity. If you look out 3 years with the recovery plan, that'll probably be a double from these levels. So there's a lot of things to do. So then I mentioned here the pitchboard podcast. This was the most detailed and thorough interview I've ever participated in. Andrew drilled into my investment process and how I value businesses and adjusted data. If you ever wanted a clear look under the hood, this is it. Have a listen. You'll be glad you did. This was a special one. This one, this is the longer one, 45 minutes. And then there's the other one that I got to include in this as well. I'll stick it in here from Harvest, but you can find that on the website under Featured On. Anyway, sentiment, Bank of America Global Fund Manager Survey. If you're on the podcast, you're getting cut off in 9 seconds. Go to hedgefundtips.com, pull up the YouTube video, go to minute 60. You'll pick up exactly where you left off for the last 10 minutes. So a lot of important stuff. Now, sentiment. So the Bank of America did its Global Fund Manager Survey for March. This week, we put out the full summary here. We're going to go through a key highlights, but you're going to see why I've been saying the risk to the markets is to the upside, not the downside, based on the pessimism and how people are positioned. So first off, when everyone's on one side of the boat, it's time to take the other side of the trade. Global growth expectations are the lowest since summer of 2008. And profit expectations are the lowest since the COVID lows in 2020. Were those sell opportunities or buy opportunities? Those were generational buy opportunities. That's where you got rich buying in 2020 and in late 2008. So, and anyway, so there you go. Profit expectations the lowest since COVID. It's down to the great financial crisis levels. It's unbelievable. So next. 60% expect a bear market in 2022, but the yield curve hasn't inverted, and you usually get the recession, 6 to 18 months after. We're not even at inversion, and we actually started to move the other way today. We'll see if that we get follow through. 60% of investors, mind-boggling. Last month, it was 30%. Opinion follows trend. It's mind-boggling. We say, like, if you're new, it's understandable if you're affected by price and when you've done your work. 90% of professionals are affected by price and emotions, and they, it is what it is. It's just human emotion. It's never going to change. No matter how many algos or computers, they're programmed by humans. It's all the same story. Cash levels are their highest since the pandemic lows. Was that a buying opportunity or selling opportunity? Should you have been buying stocks in December of 2008 or selling them? Should you have been buying in June of 2012 or selling them? It's the same thing over and over and over. European equities are setting up. I think that the guy who asked the AMA question is spot on. I think that was JT. We got to do more work here. We've just been so focused on our big bets with Biotech and Baba, getting those square and getting exposure. So we'll start to do some sniffing, more aggressive sniffing around Europe in coming weeks. Net 4% of portfolio managers were overweight global equities in March, down from 31% in February and 55% in January. This is mind-boggling. From 55% net overweight, which is to 4%. I mean, that's all you need to know. Hedge funds' net exposure to stock markets at its lowest level since April 2020. I covered this last week. It was their biggest sell down last week. They sold in the hole. And they're gonna have to chase back up in coming weeks and months. Most crowded trade is now long commodities. So guess what? We helped them out in the last few weeks. Unloaded all of our energy stocks to add more to China and to biotech, and that's exactly what we did. Consumer sentiment is nearing great financial crisis and European debt crisis lows. Should you have been a buyer or seller at those levels, you would have made generational money. And I think in some pockets, the similar things are setting up. Most indicators are at or near their major points of inflection. JP Morgan put out 8 of these. We've covered all these. Equity skew, put-call ratio, RSI on Euro stocks, RSI on S&P 500, AII bull minus bear, hedge fund beta, speculative positions, and futures contract. They've been getting this wrong. Let's see. Commercial, non-commercial, longs minus shorts. But they're measuring this off the E-minis, and institutions don't trade E-minis. So that one's been misleading, because if you actually look at the full contract, it tells a different story. Here's what happens after a 20% drawdown in the NASDAQ. NASDAQ composite performance after 20% peak on average since 1972. 6 months later, it's up 10%. 1 year later, it's up 13.2%. Recent market behavior is typical midterm years, according to Ryan Dietrich at LPL. You have this pullback, which averages 17.1%, 16.3 median. Average return 1 year later off those lows is 32%. I think our drawdown is going to be more modest, and our upside is going to be more modest for the general indices. Sentiment Trader put this out. Nasdaq Composite fell to 52-week low, then surged at least 2% on back-to-back day. This happened 5 other times in history. 4 of those times marked multi-year lows, so you can just follow along, okay, and see what happened next. Another Ryan Dietrich, VIX closed beneath 30 after 11 consecutive days above this level. This could be a good sign, as when previous streaks ended, it brought some solid returns. A year later, higher 11 of 12 times and up nearly 22% on average. Macro charts, I always love his stuff. Tech is near the most oversold levels in history. Bears see big bear markets. Bulls see historic rallies, even some in bear markets. Traders only react. They buy strength. Set stops and follow the market. Be prepared. So he's looking all these green lines. They generally represented huge moves. And we're not in a recession. You need 2 quarters of negative GDP growth. This is more in line with a bull, and it could be a ripper, face ripper, especially in tech where everyone's dumped them out in the last 2 months. This guy, Alan Cohn, puts this out. I've covered this in the past, last summer, but basically showing how markets consolidate, then they trend for 18 years. They consolidate, they trend for 18 years. They consolidate. We only broke out in 2013, so we're 9 years in. We're basically halfway through a secular bull. That doesn't preclude the 1987s when you get these scary drawdowns, and we'll have more of those. You had them in the 60s, you had them. But this is generally, we had this long consolidation bear market. That was from 2000 to 2013. We're 9 years in, and yeah, we'll get more bumps along the way, but the general trend, and if you look at the demographics, which we've covered for months, is very constructive. My guess is they stick save it like 1994, the inversion, and we extend the cycle another few years. Number 15, the pain trade is up. The market is designed to inflict the most pain to the most amount of people at any one point in time, i.e. it is designed to fool most of the people most of the time. Based on how people are currently positioned, we believe max pain is higher, not lower. Click on the image to enlarge. I did a survey on Twitter, and basically, I don't know. It's not. All right. It said basically 88% of people. Okay. What do you think more of the market is positioned for right now? New lows or new highs? 78% said that the market's positioned for new lows. And what I said was, if this is true, what is the max pain for the market? If 78% are positioned for new lows, max pain is the market moves higher, and that's exactly what's happening. That is, what move would cause the most pain to the most participants based on how they're currently positioned. Now on to China. I sent these 2 charts to a friend of mine who was questioning his positions in China tech on Tuesday. I told him I was frustrated too, but not worried. Nothing had changed in the underlying businesses, and eventually the intrinsic value would be realized. I also pointed to the fact that these were likely levels that the institutions would come in to defend the stock, as that is where the long-term holders were concentrated. So where was Alibaba? $77 when I sent him this, and 10 was at $40 when I sent him this. And he hung in there. He's a smart guy, and he's going to make a ton of money, as he always has. So there you go. We posted this tweet over the weekend when sentiment was despondent. History doesn't repeat itself, often rise. This is my marketing assistant did this. Brilliant headline here. Last few times Hong Kong was trading below book value, sharp rebounds followed. If you don't remember this, go ahead and review it. It just shows where we are in the cycle. This was also covered on the Money Show a couple weeks ago. We're trading below book, and what happens in the following 12 to 24 months, and then what happens to Alibaba on a relative basis. Then I posted this. We posted this the next day regarding Alibaba when someone was whining about the stock on Twitter. Click on the image to enlarge. This one was good. So when COVID started, I think I did this one over the weekend. Okay, yeah, here it is. All right, when COVID started, a reporter asked then President Trump, quote, "What's going to happen to all the restaurants?" This was like February or March of 2020. He replied, "Oh, don't worry about the restaurants. They'll still be there." They may have different owners, but they'll still be there. and no one really got the joke about that. I mean, it's not a joke. It's sad what happened. But it's a travesty what happened. But he was right. The underlying business was going to be fine over time, okay? It was a temporary exogenous event. I mean, if all these restaurants were public companies, we actually bought the Brinker bonds during that time. I think they traded down to 20 cents on the dollar. So anyway, he replied, don't worry, they'll still be there. They may have different owners, but they'll still be there. The same can be said for Alibaba. The business is still growing, regardless of price. Weak holders that gamble on price will get taken out on the short-term noise, and strong holders will gain a larger share of the business on sale. Don't worry, the business will still be there, and it will still be growing, which it is. It just may have different owners after the storm. A year from now, we'll see who won. And that was my quote in the middle of the storm. And I think that's held true. And I think a lot of people were taken out of the stock this week. Now they're waiting for a retest that's never going to come. And it's one of those once in a lifetime missed opportunities. But there's still plenty of opportunity out there. And a couple of the Ask Me Anything questions addressed it. Okay. Okay, this was another one that Presley put out. Just yesterday, China internet stocks were deemed uninvestable. Suddenly, after a significant gap up, everyone's going bargain hunting. This was, he cut this out from the Justin Jarman Harvest podcast. Again, you can find that under featured on right here. It's probably the third or fourth thing down. And I like this one because actually that's not going to play, but play that. It's 1 minute and 41 seconds. You'll see what I'm talking about. And then I put here, quote, of note, the major sell-side analyst, who shall remain nameless, that downgraded Alibaba to a sell with a price target of $65 on Monday is the same analyst to put an overweight on the stock in early January after the $30 bounce off the December lows. He also had a, quote, overweight $320 price target on Alibaba in April 12th of 2021. Opinion follows trend. Sentiment, still weak. 22.5% on the AAII retail sentiment. 22.5 bullish, down from 24%. Bearish rose to 49.8% from 45. Retail investor fear is back to 2020 pandemic low levels. Should you have been buying or selling? Good question. CNN fear, you know what we were doing. CNN fear and greed index rose from 16 last week to 22 this week. Fear is still near its highest level since the pandemic lows of 2020. Should you have been buying or selling? And finally, the National Association of Active Investment Managers. I think we saw the new one was up to, 44 or something like that. They're still at their lowest levels, equity exposure since the pandemic. They were the same way in the middle of the pandemic. We're buying. Everyone's waiting for the next leg down. It never came. Rip-roaring rally, off to the races. So that's the story there. You can go through the full fund manager survey. There's like 20 other charts we didn't cover. That's the yield curve we covered. This is the biotech earnings that we referenced in the Ask Me Anything that Carter posted. And this is earnings are still growing. We're getting close to that 230 number we've been talking about, 226.20. They went up another buck or so. And then the data, look at the Chinese data. Industrial production, 7.5% versus 3.9. This is a lagged effect of stimulus in November. We've been talking about this for a couple of months now. Retail sales, 6.7 versus 3.0 in the middle of COVID lockdowns. Unbelievable. Chinese unemployment rate was at 5.5. That shouldn't be green, that should be red. And then the U.S. numbers. The PPI year on year came in a little better expected. That should actually be green because it's 8.4 versus 8.7% estimated. Even the core PPI was better than expected. So some positive green shoots, so to speak. Month-on-month PPI came in lower than expected, 0.8% versus 0.9%. Crude had a build of 3.7 million barrels versus a draw expected of 1.8. So that's some positive news there. Core retail sales, slightly weak for the U.S. That's a sentiment thing. That's inflation. If oil comes down, if this thing gets resolved, that'll come back up. Huge build on the crude inventories, 4.3. Wait, what was the other thing? Oh, that was the API. The EIA, the real number, 4.3 million build versus 1.3 million draw expected. So that's positive. We'll see if we get follow through on that. Building permits were positive, better than expected. Continuing claims were good, housing starts were good, and initial jobless claims also better than expected. Strong numbers, strong economy right there. So Jay Powell, don't mess it up. You know what you have to do. Keep that yield curve steep, and we'll be off to the races. With that said, I want to thank everyone for hanging in and hanging on, and we're going to the promised land. We'll be back next week, same time, same place. Thanks for tuning in. In the meantime, make it a great one. Bye for now.